Hello, I'm Anthony Valeri, fixed income and investment strategist in LPL Financial Research. With me is John Canale, economist and investment strategist in LPL Research as well. Here today to talk about the fall 2014 market outlook. And John, when we look at our outlook, we look at the economy as measured by GDP growth, really meeting our expectations, even a little ahead.
We had a difficult start to the year. Poor weather dragged GDP down by 2 percentage points in the first quarter. There's some concern that was not all weather, but the data we've seen in the second and third quarter suggests that the economy, the underlying economy, is pretty strong. More than 4%, almost 5% in the second quarter. Here in the third quarter, closer to 3.5%. So we're looking pretty strong on the economy. Eventually, that's going to get the attention of the Federal Reserve.
Yeah, they meet next week, John. The Fed widely expected to announce an end to bond purchases. We've been expecting that for a long time. They're also likely to announce that they'll get closer to rate hikes as well about a year from now, John.
Yeah, and what they're looking for there is the slack in the economy, how quickly that slack's being taken up. They're looking at GDP growth, but they're also looking at things like the unemployment rate, the quit rate, how quickly the slack in the labor market's ticking up, and then how quickly inflation's moving higher as well. So all those things the Fed's going to consider over the next couple of months here, but next year the Fed's going to be raising rates almost certainly.
And the ECB as well, John, took a step towards trying to promote better growth here. Late August, in fact, was the first signs that they might take another step in that direction.
Yeah, at the Jackson Hole Conference of the Federal Reserve, the president of the ECB, Mario Draghi, hinted that the ECB would take some action, and indeed they did here in early September. They cut their deposit rate. They thought about doing some quantitative easing in the form of buying asset-backed securities, and just that alone has been enough to drive German bond yields higher, and that's pushed our own yields higher as well.
That's right. Those European bond yields, a big driver, a big support for the U.S. bond market this year, and helping the U.S. bond market off to a good start in 2014, actually a good year. Now that the ECB has come out with those measures that might stimulate growth, we'll have to see if that actually comes through. But that's put a stop to the rally in European bonds, which in turn has put a hold on U.S. bond market strength as well. We think that ultimately reverses, John. We think the track for higher yields will ultimately manifest itself. And really, when you look at fixed income markets, they're not priced for central banks, especially the Fed, to begin to hike interest rates. And the bond market is pricing in a first rate hike about a year from now, in August to September 2015, but yields are still too low for an eventual rate hike. We think they move higher in anticipation of that, and also in response to that stronger growth, John. So when we look at fixed income markets, we look for positioning in more credit-sensitive sectors, still hold that high yield overweight bank loans. That'll benefit from that stronger economy, lower defaults, good fundamentals, but also hold those high-quality intermediate bonds to help provide diversification.
And on the equity markets here in the middle of September, the stock market S&P 500 is at the low end of our 10 to 15% target range for the year. We see further gains here in the fourth quarter. Usually in the fourth quarter of a midterm election year, stocks do head higher. And then next year, if you look out to 2015, it's the year 3 of the presidential cycle. That's always also a pretty decent year for stocks. Earnings, of course, are the key here. Earnings growth, surprise to the upside in the second quarter, up 10%. The third quarter earnings reporting season starts in about a month, so we'll be watching that closely.
Yeah, good backdrop for cyclical sectors, John. And with an underweight in bonds, I think the way we think should be positioned here for the remainder of 2014. Well, John, thanks for your comments. Again, I'm Anthony Valeri in LPL Research. Please stay tuned for our 2015 outlook, which will be released late in fall 2014. Thanks for listening.